Hello world, welcome back to my channel. If you're new here, my name is Tommy, and every week I make videos about personal finance, investment strategies, and everything in between. If such topics interest you, subscribe to join our community of like-minded investors. Today we'll be discussing enterprise value. What is enterprise value, and in what situation should we be using it instead of market capitalization? Let's get started, shall we? Welcome to Enterprise Value Explained. So to understand EV, we need to understand how it compares with price or market capitalization. We'll then discuss how enterprise value might be more useful, and we'll see how it's used in certain valuation metrics. And finally, we'll share some key takeaways. What's the difference between enterprise value and market capitalization? So market cap is simple. It's one of the things you see on Yahoo Finance or Seeking Alpha, along with the price per share. So market capitalization is simply the total number of outstanding shares of a company multiplied by the price per share. The total number of outstanding shares varies from company to company, and they can issue out more shares over time, which is what is known as dilution. Enterprise value, on the other hand, is more comprehensive. It takes into account the total liabilities and cash equivalents of a company. So EV is simply market cap plus debt minus cash. So how might enterprise value be more useful? EV can be thought of as the theoretical takeover price if a company were to be bought. One interesting thing I found when researching this is that takeovers are hostile, unlike acquisitions. So ironically, smaller companies with excellent balance sheets are actually easier to be taken over, unless they have certain capital structures or there are laws and regulations that prevent that from happening. Enterprise value is also used in other valuation metrics. Let's look at a couple of them. First, enterprise value to EBITDA. EBITDA is actually earnings before interest, taxes, depreciation, and amortization. It is typically used by analysts to compare similar companies, either within the same sector or industry. The second valuation metric is enterprise value to free cash flow. If you recall from our video about free cash flow is calculated as cash from operations less capital expenditure. So this is arguably a more accurate valuation. And similar to the price to free cash flow ratio, you can invert enterprise value to free cash flow to get the free cash flow yield. So let's apply this to a couple of companies. First, let's try this with McDonald's Corp. So let's use their free cash flow for their 2020 fiscal year, which is $4.6 billion. We then need to find out their total liabilities and their cash and equivalents. So as you can see, McDonald's has total liabilities of $52.6 billion and cash and equivalents of $3.4 billion. So we take the current market cap at the time of this recording, about $157 billion. We add the debt and we subtract the cash and equivalents. This gives us an enterprise value of about $206 billion. So let's calculate the enterprise value to free cash flow. We take the free cash flow from earlier, $4.6 billion, and our enterprise value of $206.2. We divide it, and this gives us a multiple of 44.8. And we invert this 44.8 to get a free cash flow yield of 2.23%. So if you were to own the whole of McDonald's, this is how much free cash flow you will be yielding if you accounted for the debt. Next, let's apply this to Apple. Apple doesn't report the free cash flow directly in their consolidated statement of cash flows, so we'll use cash from operations instead. So their cash from operations is about $104 billion, and their capital expenditure is about $12 billion. So we'll subtract that, and this gives us a free cash flow of $92 billion. So Apple has a market cap of $2.8 trillion. We add the debt, which is $288 billion, and subtract the cash and equivalents, $35 billion, and this gives us an enterprise value of $3 trillion. Let's calculate the enterprise value to free cash flow. We simply take the numbers and divide them, and this gives us a multiple of 33. We invert it to get a free cash flow yield of about 3%. So some key takeaways about enterprise value. It's a more realistic takeover price of a business compared to market capitalization. And interestingly, a company that has more debt can protect itself from a hostile takeover. Enterprise value is also more useful if you want to value businesses with a high amount of debt. And the two different valuation metrics have different purpose. So I think EV to EBITDA is only useful for comparing companies within the same sector and same industry, assuming that they have a very similar debt profile. On the other hand, enterprise value to free cash flow is close to the absolute true yield of a business when you invert it. This is something that I find more useful. We hope you enjoyed our breakdown of enterprise value. If you'd like to hear more from us, subscribe to our channel to get notified every time we release new videos. Gently tap the thumbs up button for the almighty YouTube algorithm. And if you found this helpful, share this with your friends and family. We'll see you in the next video.